Okay, let's continue with chapter 3. This is financial institutions. We're going to talk about further talking about different financial institutions and how they act as intermediaries for savers and spenders, right? So this is where we're going to expand and go more into detail about the different intermediaries and how they act and how they bring, savers and spenders together, right? So let's talk about this. Says financial institutions, if you owe the bank $100, that is your problem. Here's the thing: if you owe them 100 million, that is the bank's problem, right? Because the bank's got to come up with that 100 million if you can't, and that's a big, big liability, right? So it is an asset for the bank, but it becomes a liability if you can't come up with the funds. So what are we going to learn in this chapter? We're going to explain the process of intermediation, how banks act as intermediaries, and the role of financial institutions in that process, right? And we're going to talk about the different financial institutions that act as intermediaries. We're going to define commercial banks and explains how reserve requirements influence their operations. We're going to talk about how the reserve requirements are there, but reserve requirements have changed and they're dramatically changed. And now, the reserve requirements aren't such a big deal, and I'll talk about that. This is more of an economic subject, but I can go into that and tell you why certain things are the way they are today. And then we're going to describe how the Federal Reserve regulates financial institutions, right? How do they oversee financial institutions? How do they make sure banks, different intermediaries are doing what they're supposed to do? And explain how savings and loan associations differ from commercial banks. We don't really use savings and loans anymore. They really fell out during the 80s, and we'll talk about that, why they had so many failures during the 80s. If any of you have ever seen It's a Wonderful Life, you kind of have an idea what a savings and loan is. And that movie, that's what George is trying to save, and that's his company's business is a savings and loan. And what he's trying to do with that. And you can kind of see how that goes. We're going to describe how credit unions operate, and we're going to identify the major characteristics of finance companies, insurance companies, and pension funds. All of these act as intermediaries for us. So we're going to talk about how they act that way. You may not see them that way, but many of these companies, that's their big the majority of their business is acting as intermediaries, just like banks. So the role of financial institutions as intermediaries are middle persons, right? So it's bringing in two parties together, right? And in this situation, intermediaries are acting as the middle person, is bringing in people that save, savers, and debtors, right? People that need to spend. So a household with surplus funds can purchase a savings account at a financial institution, the bank, SNL, right? Or a savings and loan, or not Saturday Night Live. This is yeah, savings and loan or credit union channels through those surplus funds to a firm, government entity, or a household that needs them. Right. So if you have a savings account, if you have anything that you're willing to invest in, these intermediaries act as a place where you can store your funds and have them there, for yourself and saving and earning interest on them, while at the same time they act as lenders to people who need funds. In this way, small surplus units can be packaged together to meet the need of large deficit economic units. The one problem we have, you ask, why do we need intermediaries? The problem is we have a bunch of small savers, right? Even if you yourself are saving a pretty good amount, five, even have a savings account of 10, 20,000, that's not enough nowadays for one person to lend to another, right? Most people are going to purchase a vehicle, they're going to make big purchases, businesses are going to purchase equipment, people are going to purchase homes. These are large loans, right? And so we have one problem. People that usually save in small amounts, but there's usually a lot of people that save, and then there's people that need the funds to need to borrow, and there's usually they need large amounts. And so in this way the intermediaries can act and put these two parties together. Services offered by financial institutions, denomination matching, right? So denomination matching, there you can save, you can do savings, you can trade currencies and things like that. For the most part, and we'll talk about denomination matching. Uh, households generally save a small amount of surplus funds to invest. They can put small amounts into savings at a time. So allowing you to save as much as you like, right, in small amounts, but at the same time being able to serve those who need large amounts, right? So households generally have small amounts of surplus funds to invest. They can put small amounts into savings at a time. Like somebody that's saving 5, 10% of their pay every month, they have that in the bank, right? You have and but at the same time, those funds don't stay in the bank, right? This is how banks make money. We're going to talk about this more when we talk about commercial banks. But banks make money by offering you interest on your savings and at the same time, then turning around and putting those funds to work, right? And they're paying you interest for putting it in their bank. At the same time, they are lending those same funds out to other people and charging them more interest to make a profit, right? So usually these small amounts we put in, we earn a little bit of interest, right? But those who need loans usually require large amounts of funds. They can borrow from for business purposes or buy a home or an automobile, right? So people can save at small amounts, keep those amounts in the bank, earn interest, and make money off of their funds. But at the same time, the bank is lending those funds, and they're able to take the funds of multiple savers and lend them to one person or one company or one entity that needs to borrow those funds, and they're able to charge a larger interest rate so they can make money on those funds. And they're able to take those funds, lend them out, right? At the same time, they're paying you interest for letting you use their fund, letting you use your funds, and then they're lending those out and making interest on the loans that they apply. But the problem is usually there's a lot of savers, right? And few borrowers, but the savers aren't putting as much. So these are surplus economic units. So these are all your savers, surplus economic units, and people that are just contributing every month, or people that are having money in their savings account every month. They're putting funds in, right? And then you have debitors, right? So you have deficit economic units, people that need to borrow the funds, right? Most of us that are going to make big purchases today cannot make the big purchases outright. I don't know about you, but I myself had to take out a loan for my car. I had to take out a mortgage for my home. I did not have the funds to outright purchase these things, right? And what I had to do was I had to borrow money. I had to borrow money from a mortgage company. I had to borrow money from a bank. And we're going to talk about selling financiers and small finance companies and other finance companies, right? That's where I got my car loan through the business itself. But that is where we can use, and borrow funds. And you have many savers, they're saving a little bit. Maybe some people are putting $50 a month in their savings account. Maybe some people are putting $500 a month in their savings account. But as those funds sit there, they're being used to supply people who need to borrow those funds. And you cannot have as many people borrowing as saving, right? Because you're pulling from many people. But this allows us, right? This answers the question: why do we need a bank? Why do we need intermediaries? Why can't we just lend the funds to somebody personally and collect the interest? Because usually we do not have enough funds to serve one person, right? We need multiple savers to then finance one deficit, right? We need multiple surplus economic units, as you can see in this picture, to fund one few deficit economic users. So services offered by financial institutions continued. We have maturity matching. Households and business savers generally want to lend for only a short period of time. Savings and checking accounts are usually available for immediate withdrawal. So, how do you do this, right? One of the things is we kind of entice people to try to leave their money in the bank longer with higher interest rates and things like that. But here's the thing: most people will put their money in and want it very quickly. So, how do we do this? Financial institutions are able to do this by maturity matching. They're able to lend out for long periods of time, right? So people in the short run, people want their money very quickly, right? But in the long and lend for a short period of time, but borrowers often want to want long-term financing. Institutions can give 30-year mortgages and long-term loans to businesses and government entities. This is one of the things that we found out with mortgage-backed securities, right? How do we get people to want to keep their money in the bank or want to finance these long-term deals? Well, what we found with the 2008 crisis, and this is still happening to this day, is what we have mortgage-backed securities. So what we do is we combine a lot of these loans, and instead of the bank holding them, right? How does usually a bank or a financial institution usually fund these things? Usually they do things like CDs, or they offer, way things like, if you put your money in, we're going to give you a good interest rate, but you have to keep it in for a certain amount of time. So they're persuading people to keep the money in the bank so they can finance these long-term loans. But they also do things like issuing short-term CDs, doing a year CD, and then doing, what they'll do is then they'll offer another CD the next year. We'll talk about this later on. They'll offer another CD to cover the loan for the next year and offer more CDs for the next year, and keep on every year. They just renew those CDs, right? And then offer them every year, renew those contracts or reissue them, pay out the interest rate, and hopefully they're making more money by issuing lower interest rate CDs than what they are by, than that 30-year mortgage. Another thing is what they'll do is they'll sell them as mortgage-backed securities. So what they'll do, this was very popular and it's kind of slowed down, but they still do it. Is what they do is they take the money and they take these loans and they combine them all up, and then they sell them as a mortgage-backed security. So then you can invest in that, and you have these high interest paid loans. They're supposed to be, usually they have good backings, and they're these people that receive mortgages, they went through a process and they're pretty faithful on, and they have insurance on their loans. And so they are, even if they default, the mortgage will still be paid off, and this is for people that want good long-term interest rates and good long-term securities, right? Something that they can be paid for in the future. And so what they do is then they buy these mortgage-backed securities, and instead of paying back the bank every time these people are paying into their loan and paying off their house, their mortgage, they are paying towards these securities or these investments, and people are receiving the benefits of those investments. Financial institutions also absorb credit risk, right? So financial institutions, I don't know if you've ever taken out a loan, right? Individual lenders cannot easily evaluate credit or risk or borrowers, right? Of borrowers. They also cannot generally afford to take risk of losing or limited savings. So here's the thing. Here, if we were to lend our money, person to person lending, this is something, we've done in smaller loans. People have started to do this in like third world countries and trying to get farmers to, grow crops and things like that. But here's the thing, you don't know if that person's going to pay you back. And that's okay if it's maybe $1,000 loan, if you're willing to risk it, or maybe if it's for a good cause, $500 or $100 loan, and you're really not too worried about getting those funds back, or it's not going to devastate you if you do, right? And so, um, you do these things, these limited savings, and but if you're going to do a big loan, right? Banks take on that risk. They absorb the credit risk. They, if people don't pay back their loans, they're not going to take away your savings account. They're not going to take away your investment, right? So they go through a credit process and vent every person that wants to take out a loan. And so they have the expertise, they have the people that are hired to go through there and find people that are they're more likely, right? They're taking less of a risk because they go and vet these people and they make sure that these people are going to be able to put that. So institutions have the necessary expertise and also are in better position to absorb an occasional loss, right? So because they're making money, they're making profits, they are able to eat those losses a little bit, right? And it cuts into their profits, but it doesn't take away from their save uh, you know, people that have savings in their company or in their bank. So this is where they absorb that credit risk. So role of financial institutions. Intermediaries help facilitate the flow of funds in the financial marketplace, right? So what happens? Financial institutions, all right, they receive money, they go and they issue securities, right? And then what? people do is they purchase money and they buy those securities, right? So securities, we talked about this, are anything that's going to provide money in the future. It's like an IOU. So they'll sell things like CDs, they'll sell money market, um, um, different money market accounts and things like that. So they do all these things. And so when we're putting money into there, right, even savings accounts, those are securities, they're paying interest rates, right? So they issue securities, right? They take in money, issue securities, and then we purchase securities and issue money for those securities to, earn an interest rate and investment. Now, commercial loans, right? This is how the money comes out. The money goes from the commercial bank to the business, and then the commercial loans, right, come in to are being paid off by the bank, are being paid off by the business to the bank. Checking accounts and households have checking accounts and savings accounts. Now, one of the things I would ask you, how much do you think really of the banking, when we look at what banks have in their reserves, what consists of those reserves? Would you say, how much of it is checking accounts, how much of it is savings accounts? And I asked my students in my economics class this, like, how much do you think of the banking industry? How much do you think of the accounts consist of checking and how much consist of savings? And because we usually think mostly everybody has a checking account, that most of the accounts are the percentage of money in the bank is going to be mostly from checking accounts, right? You would be wrong. Over 90% of the accounts are savings accounts, right? The funds that make up reserves are 90% savings accounts. Only less than 10% is checking, right? And so we say checking accounts to households, the money goes into the bank. Yes, that is true. They are using some of these accounts, right? But most of the money they're pulling is from savings accounts because that is less taken out less often, and it's from bigger savings accounts. So you have some people that make up these huge savings accounts, and some people that a lot of us, some people don't have savings accounts. But the people that do, there are some that have extraordinary amounts of money in their savings accounts. And so that takes up. Now, insurance. How do insurance companies act this way? Insurance company gives money to businesses and or money insurance policies to households, right? So households pay money and they get an insurance policy, right? And then that money goes out into businesses to pay money for stocks and bonds, right? So what happens is the insurance company goes out and then they purchase stocks and bonds, which are securities from businesses to make interest off of the funds that they receive from households for insurance policies. So don't think that your premium is just sitting there. What usually happens is insurance companies go out and buy securities, they buy investments to help pay for these, when they do have to pay out an insurance policy, they usually go out and they pay, of course, there's a pool of funds, right? That's how insurance companies work. You pay a premium, your funds go into this premium, but it's like, let's take, for example, auto insurance. I have auto insurance, I pay a monthly premium, right? It's mandatory that I have to have that in the state of Texas. If you have a vehicle, you have to pay auto insurance, right? You have to be insured. But like me, most of you guys haven't had a wreck, hopefully, in a while, right? I haven't had a major car wreck or even a minor car wreck, knock on wood, within the last, 10, 15 years. So I pay this premium, but I get the protection of, if I do have an accident, I will be taken care of, right? But for paying that premium, that goes into a pool of funds for the insurance company. And then people that do have wrecks, people that do have accidents, people that do need those funds, the insurance company pulls from those funds and pays out those, the claims. But here's the thing, they also take those funds and invest them, and they make money on top of the money that they're pulling in to help also pay for those claims and also make money off those funds. So insurance companies also act as intermediaries. So what type of financial institutions are there? The first one we're going to talk about is commercial banks. These are things like Bank of America, um, Wells Fargo. These are, American Bank here in town. These are all commercial banks. So the thing about commercial banks, and we're going to talk about them more in detail. Here's a link to If you go in there, you can click on the Federal Reserve Bank of Boston, Dallas, Kansas City. This is, those are the 12 part of the 12 regional banks to control in the Federal Reserve. Uh, that you know, Commercial banks then report to these banks, their regional bank, and then those regional banks then report to the Federal Reserve. So types of financial institution, commercial banks. The primary purpose of commercial banks is to take business deposits and lend funds to businesses, right? And individuals, right? So commercial banks, they are for profit, right? So they will charge fees. They will usually give higher interest rates and they usually charge higher interest rates, right? So the thing is about commercial banks is they are a for-profit entity. Think about that and know that, right? I love USAA, but I know for a fact that they are a for-profit entity. And that is also they're in competition, right? So they're trying to make profits. They usually have, and we'll talk about this later, but credit unions are nonprofit. And if I go to my educator's credit union account and I go to my USAA account, uh, I'm gonna tell you, there's a vast difference in those websites, right? USAA is on top of it. They spend a lot of funds to update everything. They're trying to attract more depositors. They're trying to attract more people because they are making profits. Educators, they do make enough to pay off their employees and things like that, but they are not in it for the profit. We'll talk about credit unions here in a little bit. So commercial banks, um, their primary purpose is to make a profit. Take in deposits and make loans, right? And they also, provide other services now, like investments and things like that. Commercial banks. Now, savings and loans, you don't know too much about. We don't hear about them. Their primary purpose is more in the mortgage lending, right? Savings and loans' primary purpose is to take deposits from households and to lend funds for home mortgages. Banks do more business work. They do more personal loans. They're in the realm of not so high mortgage, right? Savings and loans, they act as a bank, right? And they are for profit and they have shareholders and everything. I forgot to tell you, commercial banks also have shareholders and they're in it for the profits as well. But their primary target is mortgages. And this, if you go back to, and it's not Christmas time, but if you ever get the chance to watch It's a Wonderful Life, it is still a good movie, even though it's black and white. Though they do have this, right? You will see that the primary focus is making mortgage loans, lending money out to homes, right? And because of this is, they've taken a beating in the 80s. There was a lot of defaults and the majority of savings loans went bankrupt during that period and got taken over by the government. So we don't see a lot of savings and loans today. What we do see are credit unions. Now, credit unions, right? These are non for profit. They are owned by the depositors. So when you become a credit union depositor, most of the time you are a member. So you are owner of that credit union as well. They're owned by depositors, actually shareholders who are individuals, not businesses. Credit unions take in funds in primary market, make personal loans. They do, here's the thing. Credit unions, they're starting to do most of the things and making loans like banks. And there's a lot of things that you can see that are not so different between credit unions and banks, right? And there's a lot of advantages to credit unions. There, when you do take out a loan through a credit union or you do something like that, usually the interest rates are a lot lower than a bank. Why? Because a credit union is a non for profit. It's there just to pay its employees and keep the doors open and the lights running, but they're not to make a profit, right? They're not there trying to make $1 million CEOs and things like that. Their primary focus is to take care of their members who are also their shareholders. So this has angered a lot of banks, and they are trying to get And here's the thing: credit unions, for being a non for profit, don't pay taxes. So that is also an issue the banks have, and so it's hard for them to compete with a credit union when credit unions don't have to pay taxes. So banks are really pushing hard for credit unions to be regulated just like them and to be, fall in the same category. Now, All these three separate institutions, commercial banks, savings and loans, and credit unions, they are depository institutions. So they do take in deposits and make loans with those deposits. And so they take in deposits and they make loans. Now, different types of finance companies. Now, finance companies are different in that they do not take in deposits. These are non-bank firms that borrow funds to make short-term and medium-term loans to higher risk borrowers. So you will see a lot of these loan places across town, and they have like World Finance or uh, Rep. There's a few different places in town, and you'll see them, and they're usually like short-term loans or high. They're usually loan places where if you can't get a loan from a bank, you usually can get a loan from these institutions. The problem with these institutions is they are high because one thing we're going to learn in finance: the higher the risk, the higher the interest rate. So they're going to be very high interest rate loans, but they will loan out to people that usually can't get a loan from somebody else. And so, if they're there just in case your credit's not the best, you can always get a loan from them. Just know you're going to be paying a lot of interest. And so, because you people that usually get loans from these places are high risk and not paying back, they also they have to pay a higher interest. But they do not take in deposits, right? So you're not depositing at those are usually, these are people that are financed by investors or people that are looking to make a good return. So that's why they're high interest. Insurance companies. Now, insurance companies do not take in depositors, but they do receive premiums for insurance policies. This pool of funds is used to reimburse policyholders who incur losses that are covered under this policy. Life insurance insure against financial hardship caused by death. Here's the thing about life insurance. There's one of the things that they don't talk about in the book, and if you read the book, it's like, hey, but everybody's going to die. Well, here's the thing. There's whole and then there's term life insurance as well. So they didn't cover that in the book, but I'm gonna go ahead and talk about it a little bit. Term life insurance is just for a term or a period, right? So usually when I sign up for term life insurance and I'm getting these low premiums, right? It's usually because I'm either not a very high risk of dying, right? And so a lot of these places, they have you do health evaluations and things like that. But then they also have you do like they also take in, category risk and different statistics of like people your age range, how many of these people usually pass away through accidents and things like that. So then they can cover the losses if somebody passes away. Term life insurance is only for a certain period, only for a term. So like say I sign up now to get term life insurance at 43, and then it goes for 20 years, and at 63 the term is over, or they go for 10 years, and then if within 10 years if I do not pass away, they either don't renew my insurance, or they say, hey, you got to pay a higher premium because now you're at more risk of dying, and then they just keep on raising that premium, or they don't cover you at all. But whole life insurance is different. Whole life insurance is it doesn't matter when you pass away. You receive the funds from that payment, right? You receive the funds from that payment as soon as you pass away. But this is more an investment. So for whole life insurance, you usually do this. I have one of these policies that my parents got me when I was very young. And so what it is more of an investment. They pay in a certain amount, and that those funds get invested over a lifetime of investments. And then if, once that person passes away, that policy is paid out to whoever they deem it, but it's usually for a long period of time, and it's usually not for that much, and it's usually, you're paying in a quite a bit amount, and you hit a certain dollar amount. I think like mine was, if they paid it, before I was 10 years old, they pay in 1,500, and it'll pay out when I pass away, hopefully, which is a long time from now, and it only pays like 15,000, right? But that's an investment that you put in with this company, and this whole life insurance is invested over 60 years, 60, 70 years, hopefully. Property and casualty insurance insure against damage in person to a person and property. This are usually things that we all have: health insurance, auto insurance, home insurance, which also includes theft, earthquake, natural disasters, and that can be put on a lot, like in your home and your auto. Pension funds. So pension funds are also ways that people contribute. So pension funds, right? Workers and employees contribute to the fund, and then so we have different types of pension funds. We have defined benefit plan versus defined contribution plan. So you have a defined benefit plan. Let's see if they talk about it more. So pension fund employer employee contribute are put into one pot. So this is what Social Security is, but usually, I'm not going to talk about Social Security because that's not a good example. Let's say that you have an IRA or you have a pension fund with your employer, right? And you pay into this, you pay in a percentage of your paycheck or of your funds, or in like certain way, certain employers will match what you put in, right? And so you put into this one pot, and then this pot is invested, and then upon retirement, as you pay through this pot through the years of investing with this company, upon retirement, workers are promised certain payments based on age, years of service, and salary for the rest of their lives. This is something that we go through the college, right? I have a this is a pension benefit guarantee, or this is a contribution fund where I'm guaranteed a certain amount. So instead of Social Security, we pay into the Texas education pension fund. And what happens is, we pay into that instead of Social Security, and then after so many years, based on how many years we worked for the state, how much money we made, that depended on how much we contributed, will tell us when, when I retire, how much money I will be receiving every month, till I die. It's annuity till death. And so that is one of the pension funds, right? And if a company or other sponsor, such as a union, is unable to pay, the worker may not receive all the promised pension payments. So this is something ran by the state. So we're hoping that the state doesn't go bankrupt, right? They're the ones that kind of guarantee this, and called TRS. So that's what who would back this up. Pension fund, a pension benefit guarantee corporation provides some insurance in case of default. They provide some insurance, but they don't provide full insurance, right? So here's the thing about that, the PBGC. There have been times when people were gotten huge, they're going to receive huge amounts of huge payments every month, and a big pension fund. Some pilots have done that. Airline pilots have put in for a long time, and then what happens is the company goes bankrupt, or they're not able to pay the pension fund, and the PBGC then pays them, but they only pay them like a small amount of what their pension would be. So this is a defined benefit plan. This tells me exactly how much I'm going to receive every year, and or every month, and what my payment will be till death. Right? That's a defined benefit plan. Now, investment risk is borne by the employer, right? So the state of Texas in my plan takes on the risk because they are telling me they're going to guarantee my retirement when I pass away, or when I retire, hopefully not pass away. And or other sponsor of the pension fund, such as a union, right? A pension fund that has sufficient assets to honor all promised payments to workers, current and future retirees, is said to be fully funded. So we have to hope that these pensions, right, that they are making smart investment decisions. They're getting good returns on the investments that they're making in order to pay these people that are starting to retire, in order to pay their pensions. If a company offering a defined benefit plan pension fund to work its worker goes bankrupt, then the retirees and current workers are treated as unsecured creditors of the firm, right? So they become creditors, and then you will get, based on the so it's like they owe you money. So based on how much is left in the company, right? When the company goes bankrupt, its assets are sold, and based on where you land on the in line to get paid, they will pay you back your pension or what was owed to you, based on how much is left in the company's assets. Now, defined contribution plan, employer and employee contributes are placed into separate pots for each worker. Now, this is something that you may have. This is, when I was in the firms, I had one of these, and you get to decide where you're going to invest your funds. You get to pay off. Right, you get to pay into a pot, and sometimes your employer will match what you pay into this fund, and you get to decide how the funds are gonna be invested, and you get to see how them funds grow over time, right? Usually, there's an intermediary, like an investment firm, that's gonna handle this for you and help you choose the right path and help you choose the way you want to, but you get to decide with these funds. Funds are held by a financial service firm, invested as dictated by the workers' investment choices, right? So they usually have different plans and, like, this is risky, this is less risky, this is very safe. But, then it also says, this is the payouts, usually what happens in these different areas. And, if you take more risk, you're more likely to get a better payoff, but you are more likely to lose funds as well. And the save, the guaranteed spots are going to pay very little, but you're not at very big risk of losing funds. There is no specific benefit promised to the worker at the time of retirement. So, like when retirement comes, you can look at and see how much is in that pot, how much your investments have grown over time, and then you can see how much you like if you decide to retire, what that investment could pay over time as an annuity till till either you pass away or the funds run out. Upon retirement, the worker uses contents of their investment portfolios to cover post-retirement living expenses, right? So usually they use and they say you talk to the financial firm and they'll be either they'll invest in an annuity or they'll pay you out as an annuity and they can tell you with this much money we can pay you this much for so many years and they kind of guess how long you're going to live and they also will say or we can put it into annuity that's going to guarantee that they pay you till you pass. And so that's one of the couple of things you can do. Investment risk is born on the it's on the worker, not by the employer, right? So the worker, they take all the risk, right? They're deciding where the funds are going to be invested, and if those, investments go awry, the worker is at risk of not having, right? Most current employers offer defined contribution plans, not defined benefit plans. That is why it is a big deal to work in the government or work into a place that does have defined benefit plans, because most places, though they do offer better pay, and that's one of the benefits of having a defined benefit plan is that when I retire, I know exactly how much I'm going to be receiving every month until I pass, right? And so that's a big deal. Most people are taking a lot of risk with these contribution plans, and they are not, say, there's been a lot of people that, were ready to retire in 2008, and then, the Great Recession came and wiped out their savings and wiped out their pension, and they ended up having to work for a longer period of time to build back up their pension, build back up their money so they could retire. A 401k plan is an example of a defined contribution plan. If an employer offers a DCP to its workers, were to the bankrupt, the funds and the workers' retirement investment portfolios will not be at risk. So here's the thing: with a defined contribution plan, if your employer goes bankrupt, that's okay because you still have those funds separate of that employer, and the employer doesn't control those funds. You control those funds. You get to keep those funds, and you can keep on investing them. And so it's not at risk if the employer goes bankrupt, right? These funds belong to the worker, not the employer. So finance companies, insurance companies, pension funds, these are non-depository institutions. Funds come from borrowing, selling insurance policies and other claims. Funds used by securities and make loans, right? So finance companies usually have investors. Insurance companies have people that take out a policy. And pension funds are all done through contributors. They're not depositors, right? So these are contributors. Though I contribute to this fund for TRS, I'm not a depositor. I cannot go back and say, "Hey, give me my funds." No, those funds are locked until it is time for my retirement, right? So I cannot pull those funds. I'm a contributor to this fund and I am going to receive a benefit in the future, but I think right now for the state of Texas is the rule of 90. So you have to take my age plus how many years I've served in the state of Texas or how many years I've been an employee, and you combine those, and when they add up to 90, then I am eligible for retirement. So let's hope it's not, too long. Also, you can retire before you can start receiving payments, right? I can always retire. Like I can leave the state of Texas right now, right? I can leave this and quit contributing to TRS, but I would still receive benefits once I hit the rule of 90, which is going to be pretty far off if I do that. Okay, reserve requirements of depository institutions. A specific percentage of deposit must be held as reserves, bulk cash, or deposit at the Fed. The Fed pays interest on deposits of banks. So here's the thing: the Fed is who holds all the deposits, right? And banks are required to hold a certain amount. So you ever wonder why banks, why don't they just go bankrupt? Because they're required to hold money in their reserves so that they can't lend out all the money. You can't come and collect all the cash from them. Now, this was true, right? Now, let me go ahead and we'll discuss this a little bit as we go into this a little bit further. This is required by the Fed, ensures that the institutions have some liquidity to meet demand for withdrawals, and helps to control the money supply. Now, simplified balance sheet of commercial banks. Banks have to have reserves, investments, and loans and fixed assets. These are all assets, right? And then they have deposits. These are liabilities. Borrowed funds are liabilities, and bank capital equity. So that is what their equity is, right? So banks, right? Their assets are their reserves, how much money they have liquid to them right now. Investments are actually, banks actually make investments. They go and buy securities. They go and buy stocks. They go and buy treasury bills, right? They make investments as well. Loans are also an asset, right? For us, if we took out a loan, that's a liability. But for the bank, that's an asset. That is something they're going to receive a benefit from. That is something they're going to receive revenues from the interest payments, and then from getting paid back from that loan. And then they also have fixed assets, right? They have equipment. They have different things that over time they're there to help make revenues, right? They need computers, they need buildings, they need infrastructure, they need all this technology. That's all fixed assets, right? And so they have assets, and then deposits. For us, a deposit is an asset, right? Because that's cash for us. But for a bank, that's a liability because they have to pay it back. Borrowed funds, this is where they borrow funds from usually banks borrow from other banks so they can borrow from the Fed. And then bank capital. They do have investors in banks, right? That are, you can buy stocks in banks, you can make investments into a bank, and that is, the equity part of it. So the Federal Reserve, let's go. Do I want to go back? So let's go back to this, right? The reserve requirement. If you have a question about that, what is the actual, if I ask you, what do you think right now is the percentage that banks have to hold in the reserves to meet this requirement? You may say 5%. You may say 10% of all deposits have to be in reserves. You would be wrong. The actual reserve requirement right now, if you read your book, it is 0%. Why is that? You're saying, why would they let them not hold any reserves? It is because after 2008, and then since 2008, we've done a lot of quantitative easing. So the federal government has been putting more and more cash out there, more and more reserves into banks than we ever have before. So banks are loaded with lots of capital and lots of reserves. And so most banks, they won't even touch 10%. They're putting 20% inside, in the reserve requirements, and they're making they're they're holding very high reserves. So the Federal Reserve is not worried about banks being low on reserves. The one way now that the federal, we're going to talk about the Fed. The one way now the Fed controls this is through paying interest on reserves. So instead of having banks go out and have reserve requirements, if the Fed wants banks to put more in their reserves, they'll raise the interest rate that they pay banks to put reserves in. So banks will be like, why do I need to make out loans when I can just put it and keep it in the reserves, and the federal government's going to pay me to keep it there, right? If the Fed wants banks to lend out more money or keep less reserves, they'll lower the interest payments that they'll pay banks, and banks will then use those reserves to lend out and make loans so they can make more money on it. So the Federal Reserve has monetary authority. What does that mean? That means they control the interest rate. They control how much money goes out into the economy, how much money comes into the how much money they're going to bring back into the Fed and take away from the economy. It was created in 1913. We did not always have a central bank or a Federal Reserve. We've had a couple before this, but during a time period, we did not, for a time, we did not have a central bank or a Federal Reserve. Federal Reserve is broken up into 12 different districts, or uh, I say districts. I think they may Federal Reserve System. So you can see they have 12 different 12, and then you can see where the banks are located. San Francisco is the main bank here, uh, and that's this whole area here. With it's the whole you know west side of the United States with Alaska and Hawaii. Dallas is our reserve bank, and it takes over all of Texas, some of New Mexico, and some Louisiana. The central areas, bank 10, and that's going to be Kansas City, Minneapolis for number 9, Chicago. So all these different 12 banking systems all have a president and a reserve. So this is the reserve bank that is in charge of that area, right? And then these reserve banks then report to the Fed, right, in Washington D.C. So these all have a board of governors, and they all have which is called which all serve 12 presidents, right? So there's 12 presidents that get to serve on and control each one of these banks in each one of these areas, right? But then there's also what we call the board of governors, and they are selected by the president, right? But they serve 14-year terms, so it's not like every president comes in and gets to pick their own board. They only get to pick board members as they term out. The purpose of the Fed is to control the money supply, right? The Fed is the central bank of the United States. How do they control the money supply? They control the money supply through lender of last resort. What does that mean? When banks need money, they go to the Fed, right? The Fed can how you say the Fed can print money if it wants, right? And how does it do that? We're going to talk about that. The Fed makes discount loans to depository institutions, right? The Fed is the bank that lends money to banks, right? When they are in trouble, they go and save them. The Fed is the central bank of the United States, so they're the bank's bank, right? They control the money supply, lender of last resort, and they do check clearing, right? So what does that mean? Check clearing. Um, Check clearing is okay. So let's say, and now this is more digital than it ever was, but back in the day, this was a big deal. It still is a big deal. So each bank, right, has money in their reserves that go back to the Fed. And those reserves are held in their district, in their area, right, in their region. And so what happens is, let's say I buy something online from somebody else and I make a purchase, right? And I do it with a debit card or I do it with a check, right? I do it with the ACH payment. So what happens is that ACH payment, right? The Fed, what it does is it controls all the reserves of all the area. And so let's say I make a purchase from somewhere in the Kansas City location, right? And so what happens is the people in the Kansas City area, they receive the check and they deposit in their bank. And their bank says, "Hey, we need to pull money from the Dallas area and that needs to come to our bank because this person made a purchase and they're going to transfer the funds to us." So the Fed does this by lowering the reserves in the Dallas, takes away those funds from the Dallas reserve where my bank is located, and then raises the reserves in the Kansas City area for that bank, and that's how the person gets their fund. So it clears checks, it does all the transfers through the United States through the Fed is the one that makes this happen. So each reserve bank or each bank can do transactions and know, that the money is there. They do bank supervision. They supervise all banks. They do all regulatory on banks, right? So the structure of the Fed, they do all, they set all the regulations for banks. They have all the entities that regulate banks. And they also, and we'll talk about this later, they also do all the insurance of the banks. So, the structure of the Fed, there's a board of governors, 7 members located in Washington, D.C. These are chosen by the president, do 14-year terms. They are not always, when they term out, that's when the president can select them. Federal Open Markets Committee. So, this is who makes the decision of, are we going to generate funds? Are we going to put more money in the economy? We're going to slow down the economy. This is a very strong entity, the FOMC, right? The Federal Open Markets Committee. If you remember this from economics, from macro, they're the board of governors plus 5 district Federal Reserve banks, bank presidents. So not all 12 get to serve on the FOMC. Only 5 at a time for the presidents of the regional banks. And one thing you should know is that the Federal Reserve Bank of New York, since they are the ones to do the transactions and buying and selling treasury funds, they are always on the Open Markets Committee. So they rotate all the spots for the board of governor or for the presidents, right? The district Federal Reserve Bank presidents. All of them are switched out except for New York. New York is always on the Federal Open Markets Committee. 12 Federal Reserve banks corresponding to 12 districts. So here's the thing: when the FOMC does meet, all 12 presidents show up to that meeting. All of them get to speak their mind, but they do not get to vote on what happens. Only the 5 that are serving on the FOMC committee or the FOMC get to make a vote to propose what changes are going to be made. The other 7 have to sit out, but they do get to voice their opinions, and it's all documented in their notes and in their, their meetings. Members banks. So the Federal Reserve is actually regulated by the government, and a lot of these positions are appointed by the government, but they are consisted of very large private banks, right? So the Federal Reserve is kind of a different, it's a kind of an odd entity. It's not a government entity, but it is a government entity. So there's a few things that are governmental, like the positions that are being bestowed, and who runs it and who regulates it. But the funds and the control of the Federal Reserve is actually made up of uh, large commercial banks, member banks, right? So that's what who this is, the member banks. That's the commercial banks that make up the Federal Reserve. So, how the Fed influences interest rates, open market operations. So, what's open market operations? This is the purchase and selling of treasury bills, right? So, how does that influence, right? Um, 2 ways. They do discount rate policy, reserve requirements. So, they open markets operations. This is where if they want more funds to go out into the economy, say they say they want to put more money into the economy. What they're going to do is start buying up all their treasury bills. They're going to contact major treasury holders, huge, either I mean, not mutual funds, banks, different investment firms that have lots of capital but have lots of treasury bills, and they will purchase those back from them and not reissue new treasury bills. And so what that does, they'll call all these treasury bills, they'll make a deal, they'll purchase them back. And so what that leaves is a lot of funds in these different investment firms and in these banks that need to be invested. So what happens? Banks go out and make new loans. Investment firms go and invest new entities out in the economy. So that flushes the economy with more funds, right? The other way, if they want to slow down the economy, they want to take away funds from the economy, what they'll do is they'll start selling new treasury bills. And they'll contact these different, entities and tell them, they're going to give them good rates, and they're going to start flooding the market with treasury bills. And what that does is that takes away funds from other people that could be borrowing those funds and making investments out in the economy. So that's how they control the money supply. Discount rate policy. This is where since they are the lender to the banks, right? They issue the interest rate that affects all other interest rates, right? If they lower the interest rate that they will allow banks to borrow from them, then banks will lower the interest rate they will let you borrow at, because then the bank can always borrow the money from the Federal Reserve, right? And still make a profit. So this is why like 0% interest rates, that's just free money. Banks can go and borrow the money for no interest and then lend it to you at 1% and still make a 1% profit. If the Federal Reserve raises interest rates, then that's when banks and other entities, banks will start raising their interest rates because it costs them more money to go and lend you the money, right? So this is where they control the interest rate. Reserve requirements, which is really not a requirement anymore, except that now they do this through interest rates of paying on reserves. Open market operations. The Fed buys and sells government securities in the open market. Buying securities increases money supply, which tends to decrease interest rates. Selling securities decreases money supply, which tends to increase interest rates. So this one of the things I failed to mention was that when they do sell, they usually do increase interest rates as well. So when the Fed buys T bills, the Fed goes right to the public and they purchase T bills. But they usually do this through a selling. They have like their own what do you call lost words here, um market, right? So they have their own market, and that's what the New York Fed, district, they have that power to go and buy and sell T bills. And so they have like their own stock market, but it's T bill market where they go and, yes, they'll usually go, when the Fed buys T bills, they go to the public and they purchase T bills, right? But, they can only purchase so many from, personal purchasers. What they do a lot of is they go to big banks and they buy T bills from them, right? And the reserves are injected into the economy, right? So when they go and buy T bills, like I said, that's less, that's more money that's going back to the public because these investments, these banks, these investment firms, they need to do something with that money to make it. They don't want it just sitting there. So then they go and they make new loans. They go and they make new purchases. They make more things happen. There's more money available for the economy. Bank reserves increase. This makes more money, more banks willing to lend, increase the supply of loanable funds. Supply of loanable funds goes up and interest rates go down, right? If there's more funds to be available to the public, now you're competing with other entities to try to get your money out there and try to lend your funds. Usually you'll lower your interest rate to get more people enticed to borrow your money. Fed decreases rates when it wants to stimulate the economy. And that's what they'll do through discount rate. Uh, Now, when the Fed sells T bills, right? Now all of a sudden they do exactly the opposite, right? There's less money out there. They're taking away from banks that can lend to you. There's less reserves available for the public, right? This makes banks willing to lend, less willing to lend, decrease in supply of loanable funds, and then less loanable funds. Interest rates go up. So now there's less funds to be borrowed. More people want the funds, so they have to fight over those funds. And so, with less out there, the interest rates go up. So, only those who really need the funds will take it, right? Fed raises rates when it wants to slow down the economy. Also, they raise those rates, right? They'll also raise the rates on the T bills and they'll raise the rates on the discount rate, what it takes to borrow. They'll raise these rates on the T bills to entice more people to invest and put their money in T bills, less money out into the economy. Discount rate. This is where banks, when the Fed increases the discount rate, this is increases the cost of funds of borrowing depository institution, causing them to increase the rate they charge. Right. So I just described this earlier. Banks borrow from the Fed, lender of last resort. So if the Fed raises their rates, then the banks will increase their rates as well. So when the Fed decreases the discount rate, the decreased cost of funds of borrowing, well, depository institute cause them to decrease the rates they charge. So when the Fed increases reserve requirements, this decreases the amounts of fund available for lending. We'll see if they've done that. It's been at zero for a long time. I don't like to discuss this like this. I'd rather say they increase the interest rate that they pay on these reserves, then that'll get people to go. And the Fed increases their requirements to decrease the amount of funds available for lending. This is, less funds for lending equals higher interest rates again. And then when the Fed decreases reserve requirements to increase the amount of funds available, that increases the amount of funds available. Larger funds, that should be decreasing interest rates. There you go. Now it's correct. Decreasing interest rates. So the Federal Reserve, as the central bank of the United States, the Fed regulates the financial system, the nation's money supply, and makes loans to financial institutions, right? So usually banks will borrow from banks. Smaller banks will borrow from larger banks, but also the Fed will lend to the larger banks, right? They are the lender of last resort. So banks can always go and borrow from the Fed. The Fed consists of 12 district banks, the Federal Operations Committee, and the Board of Governors. The latter two are located in Washington, D.C. We just talked about this. So the Fed influences interest rates by buying and selling securities, right? Selling, buying securities reduces and increases. Selling or buying securities reduces or increases the money supply, which tends to increase or decrease the interest rates. The discount rate, this is a direct hit on the interest rate. Increases cost of funds of financial institutions tends to increase the rate they change. Reserve requirements, increasing, decreasing the amount of non earning reserves must be held, makes funds less, more available, and generally more or less costly. So, uh, but that's mostly done to interest rates, right? Let's talk about government sponsored enterprises. Fannie Mae, Freddie Mac. These are government sponsored enterprises. That means the government sponsored them, but they are not now. They are in totally control of these entities, but they do not totally back them fully, right? The only thing that's really backed fully, we'll talk about this if you read this in your book, is going to be things like VA loans and things like that. These are secured by the government. But Fannie Mae and Freddie Mac were developed, and we'll talk about this. Fannie Mae and Freddie Mac are under political pressure to buy riskier mortgages to encourage more home ownership. So these were created by the government to help people that usually couldn't get a home loan to go out and get one. But we ended up getting more people that are riskier uh, in defaulting. And so this has hurt Fannie Mae and Freddie Mac, especially in 2008. They had to be taken over by the U.S. government, and so they didn't go bankrupt. Real estate agents, appraisers, title insurance companies, home inspectors, and insurance agencies will all make more money if this happens. That's true, right? This industry will grow, but it also will help people get a house that couldn't get a house before. People with marginal credit, subprime borrowers are now approved since Fannie Mae and Freddie Mac will buy the mortgages from the originators, right? So this is where we kind of got into an issue with mortgage-backed securities, right? Fannie Mae and Freddie Mac would go out and uh, and would buy these, um, would go and buy these things, and then go out and put them in and guarantee them and make them as a mortgage-backed security. Many of these homes purchased have little or no money down, right? And these loans are approved without documentation, liar loans, or they were approved by they shouldn't have been approved at all, right? So that's where 2008 we got into a big when the housing prices fall, which is thought to be impossible. People with little or no equity in their homes went underwater, right? This happens a lot with cars, right? You purchase a car, you drive it off the lot, and you come back and it's already worth $5,000 less if it's a new vehicle. Here's the thing, usually homes don't do that. But because we were making so much money on homes and there was so much going on there, that this was one of the few times in history where homes were just overvalued. And then when the housing prices came down, you were underwater, so your home was worth less than what you had taken out a mortgage with. The mortgage-backed securities by Fannie Mae and Freddie Mac defaulted because now a lot of people defaulted on their loans because they're like, "Why am I going to pay more money for a house that's not worth it?" A lot of people defaulted, couldn't sell their homes, they let it go, into foreclosure because they weren't willing to take, some of these houses dropped $100,000 in value, $50,000 in value. And people were like, well, eventually they came back around to be worth what they were originally purchased at, but people didn't know that and they weren't willing to risk it. Fannie Mae and Freddie Mac had long been having implicit backing of the federal government. Their obligations, however, are not backed by full faith and credit in the United States. That's one of the things. The federal government has been bailing it out over time, but they're not fully backed, right? So political pressure to bail them out is enormous because it is such a huge. This is another too big to fail things. There's trillions of dollars in Fannie Mae and Freddie Mac, and the fear is that if this goes on, that they could bring down the financial system again, and we could have something again like the 2008 financial crisis. So that is it for chapter 3. You're more than welcome to reach out to me, and I am happy to discuss further, this further with you.